Drill down on the report with Dr. Tayo Aduloju, the CEO, Nigerian Economic Summit Group. Great to have you on the show, sir. Good morning and Happy New Year.
Good morning. Happy New Year.
So let's look at some of your projections there now. We see real GDP growth projected to hit 5.5%, up from an estimated 3.8% in late 2025. Inflation rate, you're seeing about 16%. Exchange rates, very important one for all of us there, 1,418 naira to the dollar. Foreign reserves, you're seeing $52.0 billion. That's for the external buffer there. Then you also say this is a defining moment. You're describing 2026 as pivotal, an inflection point. What specifically makes this year more critical than, the initial reform years of, 2024 or 2025?
So that's a good question. At the heart of the transformation required for Nigeria to go into a high growth trajectory, it requires a deep commitment to translating the gains of the stabilization phase, which we are kind of at the end of, into the kinds of results that delivers higher productivity output, especially the type of productivity output that creates jobs and reduces poverty. Currently, the gains we are seeing, which of course has translated into, you see the upward review of our outlook by Fitch, Moody's, S&P, which shows investor confidence. By itself is reversible quickly by missteps in regulatory policy and legislative reforms. So it's a crucial period because these gains, if they do not now translate into economic consolidation, driven by real sector GDP growth rate, especially getting in the industrial sector to grow, agricultural productivity to grow, export expansion to increase, massive job creation and with high job intensity, with job elasticity and poverty reduction, then the citizens don't feel it. If the citizens don't feel it and the sectors don't grow faster, then you go back into likely political constraints, social pressure and political constraints to reverse the reforms. That's why this period is so crucial, that the gains are now translated into those tangible outcomes that people really want to see. And so crucial, urgent action on structural changes and transformation in terms of energy, food systems, critical capital investments in infrastructure, especially logistics, transformation especially of those drivers of how we got to the high inflation trajectory are crucial. So, for example, just reducing the regulatory noise so that the PMS downstream reforms continue to see prices and will continue to be significant in 2026. We need the same thing with food inflation. If you look at the numbers of the central bank outlook, they say that inflation, for example, could go down to as low as 12.9%, but they based it on clearer regulatory reforms that allow for lower prices in PMS, in food, in services, and in energy. So that's why this is so important. You were speaking with Dr. Ayo earlier on about whether Nigerians will see the aggregate disinflation numbers translate into, like Nigerians say, price of fish in the market, right? We will see those changes if the gains now have reformers really steady the course on energy sector improvements, on the foreign exchange stability, on agricultural sector development, on those oil and gas performance, especially in the downstream and in manufacturing expansion. and of course, in rapid technology upgrade to ensure all Nigerians can move to more efficient forms of business services and processes. So those things are crucial, and they cannot wait. I hear people say that because 2026 is a pre-election year, reform intensity should slow down. Unfortunately, this government does not have the luxury of that. They need to collaborate with the private sector to put as hard as we can in 2026 to get difficult work done.
A difficult work because most of the time, sometimes I try to imagine, when I hear inflation numbers from other developed countries and some countries in Africa here, like the likes of Ghana, getting into single-digit inflation, and I still hear their complaints that when their citizens go to the markets, it doesn't feel like single-digit inflation. And I'm wondering, here we are, dealing with double-digit inflation for the longest time now, and definitely it feels higher, when you go to the markets. And you've mentioned the reforms at this point. After 2 years of high costs, how do you propose the government maintains, public buy-in for consolidation when, household welfare, food prices remain under such intense strain?
So you have to tackle the problem with, it's almost a mouthful, right? Productivity-led disinflation, or reducing inflation whilst increasing productivity. And the reason why is, like Dr. Ayo noted, high inflationary pressure is sticky. When inflation goes up, it doesn't come back down that easily, except where higher productivity forces deeper competition, and competition forces the price back down. So it's so important that the government steadies its course on, so for example, how do you get the price of rice down, right? You continue to expand the output, performance of rice. You produce so much high quality rice across the country that, supply exceeds demand and the prices come down, right? How do you reduce, how has the PMS prices started to come back down from where they were? It's price competition in PMS that has continued to force that price down because of that tension. And so it's important that the reforms continue to drive productivity, that productivity creates competitive markets, because it's competitive markets that continue to force the price down. And that's the key, right? The key is disinflation cannot be artificially created using subsidies alone, or government regulation of prices alone. It is better when it is driven by government's investment and support to expand the sectors that make output scale, right? Drive those prices down. And so that requires a set of things working together. One, on the cost of doing business, or the cost channel, for example. One of the things that the MSMEs have continued to complain about is that they're seeing lesser and lesser access to capital and credit. If you want to scale an economy where 90% of our businesses in the MSME sector, you have to expand the capacity for credit. And now that the banks are consolidated, we are hoping that we will see some more of commercial lending move in that direction. And as disinflation is happening, we want to see, for example, monetary policy reflect that, so that interest rates also come down. But also, we need to see the Federation become more competent and more efficient at using development finance to target the sectors that are required for massive growth and expansion. So energy, for example, especially the electricity supply industry, requires a lot of new liquidity. Whether it's going to come through the capital market and capitalization, that's something we need to see. So the next 18 to 20 months, boosting domestic mobilization beyond taxes, in the capital market, crossing that $500 billion mark to ensure that the resources required to finance Nigeria's productivity is available, is so important. And we need to rethink the Nigerian financial architecture. This year, it needs to serve capital flowing into manufacturing, into infrastructure, into energy, to bring down the price and the cost of electricity and the energy that powers our MSMEs and powers our industries. And that is what will create the expansion we will need to see in productivity-led growth. In agriculture, we need to unlock gas to urea, which is something that already the opportunities exist. So if you just pull together all the actors in the gas to fertilizer production space and just scale the output on fertilizer to drive output in agriculture. We need to see new investments go into storage facility and deeper transformation in the post-harvest storage and commodity exchange markets. And we think that these things are already on the go. There's possibly 12 to 18 months of hard work to get them across the finish line. And I think that's where the optimism of the 5.5 from NESG, our sister organization, LCCI, put it at
7%. Huge.
7%. We're not that optimistic because of reform traction and policy efficiency. We think it should be at 7%, but we struggle with whether the institution's output capacity to deliver is as high enough to get to 7% in 2026.
Right, and I'm sure Nigerians will like the part where you also talked about not increasing taxes. Nigerians are really sensitive about taxes. Right now, and that's why we keep, trying to educate on, this new tax laws at this point. But thank you so much for helping us, paint the picture there on what to expect this year. There's optimism, maybe some little caution, right there. Thank you so much, Dr. Tayo Aduloju, CEO, Nigerian Economic Summit Group. Thank you for coming on the show today.
Thank you for having me.
I'll take a quick break. When we come back, we'll get a sense of what's happening or what's going to happen with investments in internet in Nigeria. That's in a moment. Just stay with us.